What if I told you the smartest money on Wall Street is doing the exact opposite of what the crowd believes is safe right now? While headlines celebrate the Magnificent Seven as untouchable, billionaires are quietly making moves that could redefine the next market cycle, not out of fear, not out of panic, but with precision, because markets don't turn when everyone is scared. They turn when everyone is comfortable. And right now, comfort is everywhere, except where the real opportunity is about to emerge. For years, a small group of stocks carried the weight of the entire market on their shoulders. The Magnificent Seven were not just companies, they became symbols of inevitability. Capital flowed toward them not because investors lacked imagination, but because the results demanded attention. Explosive earnings growth, dominant market share, and a once-in-a-generation technology shift made these names feel untouchable. But markets do not reward comfort forever, and history has a consistent habit of humbling consensus. What we are witnessing now is not fear, and it is certainly not collapse. It is discipline. Some of the most sophisticated investors in the world are trimming exposure to these mega-cap technology leaders after extraordinary runs. When a stock compounds hundreds of % in a short span, the risk profile changes even if the business remains exceptional. Valuation expands faster than fundamentals, expectations become fragile, and future returns compress. At that point, doing nothing is no longer neutral, it becomes a decision with consequences. The selling pressure coming from billionaire portfolios is often misunderstood. Headlines frame it as abandonment, but in reality, it is rebalancing at scale. These investors are not reacting to yesterday's news. They are positioning for tomorrow's market structure. They understand that capital concentration eventually creates inefficiency. When everyone owns the same trade, the upside becomes crowded and the downside becomes violent. Risk management demands action before the market forces it. There is also a deeper signal embedded in this rotation. The Magnificent Seven benefited enormously from liquidity, low rates, and a market willing to pay a premium for certainty. That environment is evolving. Growth still matters, but price now matters more. Cash flow durability, balance sheet strength, and relative valuation are re-entering the conversation in a serious way. As that happens, even dominant companies can deliver disappointing returns if expectations are too high. Billionaires sell not because they doubt innovation, but because they respect cycles. Technology leadership does not disappear, but leadership within technology rotates. Artificial intelligence, cloud computing, and digital platforms are still powerful forces. Yet the market is beginning to differentiate between early winners and future winners. The capital leaving the Magnificent Seven is not exiting the market. It is being reassigned to areas where expectations are lower and potential is mispriced. This is how long-term capital behaves. It monetizes success and reinvests in asymmetry. It understands that the goal is not to own great companies at any price, but to own them when the odds are structurally favorable. When you see disciplined investors reducing exposure at the top of popularity, it is not a warning of disaster. It is evidence of process. Markets reward those who move before consensus shifts, not after. The quiet trimming of positions today often precedes loud narratives tomorrow. And the investors who endure across decades are the ones who recognize when a trade has gone from brilliant to crowded and have the conviction to act while confidence is still high. There is a critical distinction that separates enduring capital from speculative capital, and it lies in understanding intent. When billionaire investors reduce exposure to market darlings, the assumption is often fear. That assumption is wrong. What drives these decisions is not anxiety about tomorrow's headline, but clarity about risk, reward, and probability. Profit-taking, when executed with discipline, is not retreat. It is optimization. The Magnificent Seven delivered something rare: scale, growth, and narrative alignment all at once. They earned their place at the center of global portfolios. But markets are dynamic systems, not monuments. When returns become concentrated in a narrow set of names, the next marginal dollar no longer improves the portfolio. It weakens it. The risk becomes asymmetrical in the wrong direction. Upside narrows, downside accelerates. That is when serious investors act. This is why selling at strength matters. Waiting for confirmation from the market is not prudence, it is complacency. The most sophisticated capital allocators understand that. Valuation is not a timing tool, but it is a gravity force. You can defy gravity for a while, but not indefinitely. When expectations embed perfection, even excellence can disappoint. And disappointment in markets is punished far more severely than failure. What we are seeing now is not an exit from innovation, but a recalibration of exposure. Capital is being pulled from areas where optimism is fully priced and redirected toward opportunities where skepticism still dominates. This is not a popular trade, and it is not designed to feel comfortable. It is designed to work. Markets reward conviction built on analysis, not applause. There is also a psychological component that cannot be ignored. Crowded trades create false confidence. When everyone agrees, due diligence quietly erodes. Risk controls loosen. Volatility is dismissed as noise, but concentration has consequences. The same liquidity that pushes prices higher on the way up becomes an accelerant on the way down. Those who have lived through multiple cycles recognize this pattern instantly. Profit taking is not about calling tops. It is about respecting math. If a stock's future returns cannot justify its present price without heroic assumptions, the rational response is to reduce exposure, even if the story remains compelling. Discipline demands separating admiration for a business from responsibility to capital. The greatest advantage experienced investors possess is not access to information, but perspective. They have seen markets reward patience, punish excess, and eventually revert to fundamentals. When they trim positions in celebrated names, they are not turning bearish. They are creating optionality. Optionality is power, the ability to deploy capital when others are forced to react. In the end, markets do not compensate loyalty to narratives. They compensate discipline, timing, and the courage to act before consensus changes. Profit-taking at scale is not a signal of weakness. It is a declaration of control. And control is what separates enduring success from temporary triumph. Capital does not disappear when it leaves a trade. It migrates. And understanding where it migrates tells you far more about the future than obsessing over what was sold. The current rotation away from the Magnificent Seven is not a vacuum event. It is a reallocation toward opportunity sets that are mispriced, misunderstood, or prematurely dismissed. This is how durable wealth compounds, not by chasing what worked yesterday, but by positioning ahead of what can work tomorrow. The defining characteristic of elite investors is not prediction, but preparation. When valuations stretch and narratives become universally accepted, the forward-looking return profile changes. That is not ideology, it is arithmetic. At that point, the question is no longer whether the business is exceptional, it is whether the market is offering a favorable entry point. Increasingly, the answer has been no, so capital moves not emotionally, but deliberately. Where does it go? It goes where expectations are low and optionality is high. It flows into businesses with real cash flows, improving balance sheets, and catalysts that are not yet reflected in the price. These may not dominate headlines, and they rarely fit neatly into viral investment narratives, but they offer something far more valuable: asymmetry. Limited downside relative to potential upside is the foundation of intelligent risk-taking. This shift also reflects a broader change in market structure. For years, passive flows amplified momentum, rewarding size over selectivity. That environment elevated the largest companies regardless of incremental improvement. But markets are gradually rediscovering discrimination. Capital is becoming more selective. Returns are being earned through analysis rather than allocation. That transition favors investors who can identify underappreciated strength before it becomes consensus. There is a discipline required to buy what others are ignoring. It demands conviction without validation. It requires accepting short-term discomfort in exchange for long-term advantage. Billionaire investors understand that true opportunity rarely announces itself. By the time it becomes obvious, the pricing advantage is gone. That is why capital often moves quietly, long before narratives shift. This rotation is also a bet on resilience. Businesses with strong fundamentals but lower visibility often perform better when volatility rises. They are not priced for perfection, and therefore they do not collapse when conditions tighten. In a market recalibrating expectations, that matters. Stability becomes a feature, not a flaw. What looks like abandonment of the old leaders is, in reality, an embrace of balance. Concentration risk is being reduced, exposure is being broadened, Portfolios are being constructed for durability, not applause. This is not about timing a cycle. It is about surviving many of them. Markets have a way of rewarding those who think in probabilities rather than narratives. C. Capital that migrates early captures value that capital that hesitates never sees. And while the spotlight remains fixed on what is being sold, the real story is unfolding elsewhere. In the positions being built patiently, decisively, and ahead of the crowd. Risk is rarely where people think it is. Most investors are trained to look for danger in volatility, in headlines, in moments of visible stress. But real risk builds quietly during periods of confidence, when assumptions go unchallenged and success is extrapolated indefinitely. That is precisely the environment that forms around dominant market leaders after extended runs. When the Magnificent Seven reached a point where ownership became nearly universal, the risk was no longer obvious. It was structural. Concentration risk is seductive because it disguises itself as conviction. Strong past performance creates the illusion of safety. But portfolios do not fail because the best companies suddenly become bad. They fail because too much capital is exposed to the same outcome. When returns are driven by a narrow set of names, correlations rise, diversification disappears. At that point, a portfolio is not optimized. It is vulnerable. Experienced investors respond to this by re-engineering exposure before the stress arrives. Reducing concentration is not an admission of error. It is an assertion of control. It reflects an understanding that markets are nonlinear systems. Small changes in expectations can produce outsized moves in price when positioning is crowded. Liquidity works both ways, and when everyone heads for the exit at once, fundamentals become irrelevant in the short term. This is why discipline cap it. AL does not wait for volatility to appear. It acts while conditions are calm. It trims positions when bids are plentiful, not when they evaporate. That is not market timing. That is market awareness. The objective is not to avoid drawdowns entirely, but to ensure they are survivable and recoverable. There is also a false assumption embedded in the debate that reducing exposure means abandoning belief in innovation or growth. That could not be further from the truth. The future remains technological. Progress does not reverse, but leadership changes and the price paid for leadership matters. Owning innovation at any valuation is not vision, it is negligence. Risk management is not about pessimism, it is about humility. It recognizes that no thesis is immune to overcrowding and no stock is immune to disappointment. Even extraordinary businesses can deliver ordinary returns when expectations are extreme. That is why capital preservation sits at the center of every enduring investment strategy. What separates institutional discipline from retail enthusiasm is this understanding. Professionals do not seek excitement, they seek resilience. They design portfolios to withstand shocks, not to maximize short-term praise. When they reduce exposure to dominant names, they are not forecasting collapse. They are reducing dependency. Markets punish dependency. They reward flexibility, and flexibility is created by acknowledging risk before it becomes visible. The quiet work of managing concentration today is what allows capital to compound tomorrow. In the long run, survival is not the absence of mistakes. It is the ability to absorb them without permanent damage. Markets are ultimately a test of behavior, not intelligence. Information is widely available, models are sophisticated, and data moves at the speed of light. What separates exceptional investors from the rest is not what they know, but how they act when the environment changes. The current shift away from the Magnificent Seven is a case study in behavioral discipline, a reminder that adaptability, not attachment, is the real edge. Narratives are powerful. They simplify complexity and give investors a sense of certainty. For years, the narrative around mega-cap technology was self-reinforcing. Scale begets efficiency, efficiency begets dominance, dominance begets returns. And that narrative worked until it became universally accepted. When belief becomes consensus, it stops being an advantage and starts becoming a liability. Markets do not reward what everyone already agrees on. The hardest decisions in investing are rarely about buying. They are about letting go. Selling successful positions feels counterintuitive, even irresponsible, because it conflicts with human instinct. Success creates emotional attachment. Yet capital has no memory. It does not care where it came from, only where it can work most effectively next. The ability to detach from past wins is one of the most underappreciated skills in finance. What we are seeing now is capital being repositioned with intention, not rushed, not reactive, calculated. This is what long-term thinking looks like in real time. Investors are asking forward-looking questions. Where are expectations too high? Where is risk underappreciated? Where is optionality cheap? These questions, not headlines, drive enduring performance. Third, E is also an important lesson here for anyone building capital over decades. You do not need to predict every market turn. You need a framework that evolves as conditions change. Rigidity is far more dangerous than uncertainty. Portfolios that succeed across cycles are designed to adapt, to rotate, and to accept that leadership is temporary. Great investors respect momentum, but they do not worship it. They understand that momentum without valuation is fragile, and valuation without momentum is patient. When the balance tips too far in one direction, adjustment becomes necessary. That adjustment is not a betrayal of strategy. It is the execution of it. In the end, markets reward those who remain intellectually honest. They reward investors who can say, "This worked, and now it's time to reassess." The future does not belong to those who cling to yesterday's winners, but to those who recognize when the rules are shifting and respond with discipline. Adaptation is not a reaction, it is a strategy. And here's the truth, most people will only understand after the opportunity is past. Markets never reward those who arrive on time. They reward those who arrive early. While the crowd clings to yesterday's champions, the smartest capital is already positioning for what comes next. This is the moment that separates followers from leaders, noise from insight, and speculation from strategy. The question isn't what worked. The question is what you do before everyone else sees it. Because when the next winners are obvious, the real money will already be made.